Good morning, everyone. John Rosengard with Environmental Risk Communications in Oakland, California. Thanks for joining our webinar today on 2019 Environmental Liability Reviews. What I'll be covering today is listed on your screen now. I'll be giving a little bit of background on myself and giving you a brief elevator speech for our content, and then we'll be getting into a few of the key generally accepted accounting principles, references that are useful for this topic. From there, I'll spend the bulk of the presentation, which will run a little over an hour, covering best practices and lessons learned from similar exercises that I've been a part of. And from there, provide some ideas about content that you can use for conducting environmental liability review meetings on your side. Hope this content is useful. If you have questions throughout today's presentation, please open the GoToWebinar control panel and please type in your questions. I'll do my best to answer them in real time. But I'll also leave some time at the end of our talk here today for a Q&A at the end. So a little bit of background on your presenter today. I'm the CEO and founder of a company called Environmental Risk Communications, which is based here in California. We were founded 25 years ago. I'm the author of a software tool called Defender, which has as its sole purpose environmental liability forecasting, whether it's asset retirement obligations, due diligence, counterparty risk, remediation liabilities. All of those subtypes all fold into what our Defender software does. Consequently, over the last 25 years, I've had a hand in looking at or validating the reserves for about 4,400 individual liabilities. Some of those, due to the nature of the way our clients work, some of those are for the exact same sites. But for the most part, that's probably 4,300 unique individual liabilities that we've looked at. I've also delivered over 100 speeches and webinars on environmental liability topics, which include AROs, remediation liabilities, due diligence, the watch list tool, which I'll be covering as part of today's webinar, as well as decision analysis and counterparty tracking for multi-party cleanup sites. By the way, I'm the ASTM technical contact. ASTM International used to stand for the American Society for Testing and Materials, but I'm the technical contact for two of the standard guides that are published by ASTM International. One of those is E2173, Disclosure of Environmental Liabilities. Another is E3123, Recognition and Derecognition of Environmental Liabilities. These are roughly 25-page standard guides, single-space, dual columns. If you have any questions about those, my term runs until 2021 and 2022 respectively. So if you ever have a 10 or 15-minute chat, feel free to call me at any time. This is a topic of interest and passion to me, and if you would like to tap my expertise, my complementary expertise is always at your disposal. Feel free to call anytime. By way of background, I've got 2 business degrees, an MBA from Northwestern, a bachelor's from Georgetown. So, as we're going through this content here today, keep in mind that I'm a software developer and in some sense a management consultant, but I'm not an attorney, an accountant, an environmental engineer, a civil, mechanical, or chemical engineer, or a construction engineer. I work with environmental liabilities from a different perspective. I hope it's useful and interesting to you and that it provokes some interesting conversations as we go forward. With that, let me move forward to our elevator speech for today and a couple of just key bullet points for you to take away. Number 1, GAAP for environmental accounting and environmental liabilities is more detailed than ever before. We'll get into that in the next slide here. But liabilities themselves are still growing as disclosed on in 10Ks and on companies' environmental liability books. Third point, consistent reporting preserves institutional knowledge and improves capital stewardship. Both of those, when done in moderation, when done effectively, are very good for organizations over the long term. And more specifically, in looking at individual environmental liabilities, tools like event trees and financial modeling documents current reserves, watch lists preview future reserves. With that in mind, let me get into a comparison of how environmental legislation in the top half of our slide here has evolved with generally accepted accounting principles that focus into some extent on environmental liabilities on the bottom half of our slide. And the point that I wanted to share with you is even though the legislation got a little bit of a head start in the early 70s, environmental accounting obligations or principles have gotten more and more stringent and have really played catch up over the last 15 to 20 years. So I do want to point out that there are quite a number of individual requirements in place now, from an accounting perspective, from a GAAP or generally accepted accounting principles perspective. But I do want to point out that both have been evolving. Back in 1975, for example, all environmental liabilities were bundled up with a variety of other items into a group called contingencies. But now, today, contingencies are just one of the subtypes of environmental liabilities that are out there. So on our next slide here, which is published as a part of ASTM 3123, these are the 5 subtypes of environmental liabilities that are out there. Just moving left to right, asset retirement obligations, which cover decontamination, demolition, decommissioning of large assets. That's the first type of environmental liabilities listed numerically by FASB, the Financial Accounting Standards Board. So if you're looking for detail about that, you would go to ASC 410-20. That's the formal accounting citation for AROs. The next type is other environmental obligations, also called formally remediation liabilities or environmental remediation liabilities. Those are listed in FASB under ASC 410-30. The next type are commitments, ASC 440, which covers things like leases, purchase and sales agreements, mergers, PRP agreements that govern individual NPL or CERCLA cleanup sites. Commitments, again, are just agreements between organizations or between or individuals, not between a regulator and a corporation or an individual, that creates an obligation. Those obligations are the first 2 types off to the left-hand side of the slide. Commitments in the middle are, again, non-regulatory duties, responsibilities. In other words, they're contractually and from an accounting perspective called commitments. The next type over is contingencies, which is now under ASC 450. So the old definition of calling them FASB 5 went away in 2009. It's been 10 years already. But ASC 450 covers those types of contingencies you see listed there. If there's a state reopener of a federal site, if there's a litigation outcome or a de minimis cash out, offsite ecological resources, NERDA claims of a de minimis nature, those are not obligations. They're settled with one-time agreements and cash payments of a less than 7-figure, 8-figure nature. Again, these are smaller, more modest, less urgent, less time sensitive liabilities, and they're grouped together again because they don't fit the definitions of AROs, remediation obligations, commitments, and guarantees. So again, contingencies are still there, as I referred to in the previous slide, but they're not the catch-all that they were back in 1975. And I hope that's again useful for the U.S.-based companies that are that have representatives here on today's call. If your organization complies with the International Accounting Standards Board principles and rules, IAS 37 is the principal definer of what environmental liabilities are for your group of organizations. On the right, the rightmost portion of the slide is guarantees, and that covers the more recent evolution of environmental liabilities into things like financial assurance instruments under RCRA or CERCLA, but also the legacy of Superfund under joint and several liability. So again, if your organization is joint and severally liable with others for managing or funding the work on a cleanup site, joint and several liability is always there. You're always guaranteeing the performance of others, whether or not it's an auditable, whether it's a visible material environmental liability, depends on an individual circumstance. But I just want to again point out that these are all different types that fit into a balance sheet of a corporation in 2019. And again, it's a little bit of a moving target, so it may be different tomorrow. One additional point that I wanted to stress, in addition to the types of liabilities that are out there, are the types of money that corporations can and do use to settle out environmental liabilities. The one that we're probably most familiar with, or maybe most comfortable with, are environmental reserves or provisions for those organizations that work under IASB. Provisions or reserves mean that you've accrued for the liability or an individual site-specific liability in the past, and you're spending that money now. The idea of a reserve or provision is that you're trying to clear up tomorrow's books by recognizing problems that weren't recognized long ago. You're recognizing those immediately so that when the money is spent tomorrow, the books of tomorrow are cleansed rather of those environmental liabilities. So again, the idea of a reserve is that you're trying to recognize to some extent an acceleration of an expense even though the money hasn't been spent yet. If you're interested in the tax consequences, and there's probably one or two of you out there, feel free to call. I'll get into all of that detail. But for the most part, environmental liability spending is not deductible until the spending actually occurs. This has nothing to do with tax. This is just how income is booked by a corporation, whether it's for-profit or non-profit, on a quarter-to-quarter basis. The next type of money that's used out there, operating expenses that are not accrued for now, were not accrued for in the past, but are being spent now. So again, they're spent now and tax deductible now. The next type of money is capital expenditure, and these will be for major site improvements, for significant assets like a long-term groundwater management system, a process unit for environmental liability, and those types of expenditures that you'd say will have a long-term useful life, like an air handling system. Capital expenditures are cash expenditures up front that are depreciated or deducted or amortized over the remaining useful life of that asset. An asset retirement obligation is a type of environmental liability where the cost to decommission or demolish an asset is accrued in part at the very beginning of the useful life of the asset, and then accrued for in the remaining useful life, and then spent after the asset is shut down. And then finally, the fifth type of money that's out there is counterparty money, where cost sharing or reimbursement is performed with or from third parties. So this is, in one sense, other people's money in addition to the other four types that I've got listed here. Major calendar items for looking at environmental liabilities normally follow this type of pattern for organizations that end their environmental liability year with the calendar year. So the work in Q1 normally involves things like year-end balance confirmation within SAP or Oracle Financials, documentation of any scope changes to individual sites, verification of obligating events that have become more probable, or verification of recognition benchmarks that have become more reasonably estimable in the preceding quarter or two. In the second quarter, normally in April and May, there are updates to long-term estimates as the construction season kicks off here in North America. That's quite an ordinary step. And then if there are mid-year reserve and budget updates, those are normally performed again in the April-May timeframe. Toward the end of the summer, in August and September, there's usually a roundup of obligating events and recognition benchmarks, which I'll get to pretty shortly. And there'll be changes that are submitted for endorsement, not finalized, but submitted for endorsement, including any new sites that may have come into the portfolio in the preceding quarter or two. An audit defense and accrual requests will normally come in and be scheduled in the August-September timeframe for roughly the following 90 days. And then budget priorities for the following calendar year are usually set in that time span as well. Q4 is usually pretty quiet unless there's, of course, an audit defense or an auditing activity. If there's a major budget review, such as a significant increase or decrease in the budget for the following year. But generally, if there are no major site acquisitions, divestitures, I can hear you laughing in the background. I know this never happens, but I'm saying normally Q3 and Q4 can be pretty quiet for looking at environmental liability. So with that in mind, with that part of general accepted accounting principles reviewed, let's get into the best practices for environmental liability reviews. And what I'll be doing is covering these more or less over the next half hour of our presentation. So again, feel free to ask questions as we go along here. One of the major changes in the last, I'd say, 13, 14 years for looking at environmental liabilities has been the gradual adoption of fair value measurement, or the gradual obligation of using and applying fair value measurement for looking at certain types of environmental liabilities. The origins of fair value measurement come from FASB in September of 2006, but also the International Accounting Standards Board and the Governmental Accounting Standards Board, which covers state, county, and municipal governments here in the U.S. They both gradually and successively adopted FASB's statement 157, which is now ASC 820, as you see in the upper right corner. ASC 820 was gradually adopted by those other organizations in their own form with their own language. As you see, IFRS 13 and GASB 72 also contain these principles that I'll cover here about fair value measurement. What is fair value measurement? It's the preferred method for measuring today's assets and liabilities, and it's again called fair value measurement. If you haven't heard of it before and your organization publishes a 10K report, pull it open sometime and search for the term fair value. You'll probably see that the fair value is cited roughly 100 times to 200 times in your company's 10K or 20F report. And what it means specifically is that assets and liabilities need to be generally priced at market-based inputs, which means the liability is driven by and responsive to changes in market conditions and not based on legacy estimates that may go back a generation or more. It also means that there's a more consistent usage of a present value, which involves a discount rate, or a current value, which means canceling out the effect of inflation in stating an environmental liability. It also means, fair value measurement also means it's an expected value of several outcomes, maybe performing the work faster or slower, maybe performing the work to a residential versus a commercial or industrial cleanup standard, but also things like if the remedy just doesn't work, if the technology in the field just isn't successful, or if the remedy goes longer than expected, or if counterparties that are sharing in the cost fail midway through the process of funding the work. The idea of multiple outcomes is that an expected value is calculated, or a weighted average, or an arithmetic mean. They all mean the same thing. If that expected value is calculated, it's going to include across the span of a portfolio all the good and bad incomes, all the good luck and bad luck that can happen over the course of a generation or more. For the pricing of environmental liabilities themselves, there are three approaches available and stated out in the documents from FASB, IASB, and GASB. One is the income-based approach, which is the impact to your income, which is defined by your spending plan, which is what you normally do. This is your cash flow plan, maybe even your current basis for your environmental reserve, year after year after year, showing X dollars in 2019, Y dollars in 2020, and so on. That income basis is quite common and quite ordinary for what we do in looking at environmental liabilities. The second approach that you can use is a market-based price, to say we have, for example, 10,000 tons of soil to dispose of. We have 3 different landfills we might send this soil to. Here are the 3 different market prices today, and what we're going to book our reserve at is the average of those 3 prices, or a weighting based on our historic use of those 3 different facilities, for example. The third approach that you can use is something called replacement cost, where you're replacing the service capacity of an asset. I still have difficulty to this day, after thinking about it for 13 years off and on, about how to price in an environmental liability where we're looking at the service capacity of an asset, like a drinking water aquifer, like sediments and a wetlands area adjacent to a facility that's performing some function in soil and groundwater management. I don't have a short answer other than to say it's going to be more appropriate to use the income-based approach and periodically the market-based approach, and you may never see the replacement cost approach used in fair value measurement. So how do you apply fair value measurement when stating environmental liabilities today? Well, you have to use something called NAICS codes here in the U.S. These are North American Industrial Classification System codes, and I've got a series of 6 of them listed here in the center of the slide. The basic point that I want to give you is that the federal government here in the U.S. tracks inflation indices for these and hundreds of other different NAICS codes and publishes those numbers every month. So if you want to get an inflation index of rolling a 2018 number up to a 2020 number, Uncle Sam wants to help out and wants to save everyone time and effort, and it publishes at the Department of Labor, the Bureau of Labor Statistics, those numbers called, which are components of the U.S. Producer Price Index, are published for the categories that you see here for legal services, environmental engineering and consulting services, testing labs, solid waste landfills, and remediation services. If you again know the proportion of your spending that falls into these categories, you can use these indices to sort of keep rolling your environmental liability forecast forward year after year after year. But again, you got to do the tough thing up front, which is you've got to apportion your spending for an individual site among these codes. It's a lot easier than it sounds. And again, once you have these 6 or so, which are the most relevant to our environmental liability management work, once you have these in mind, I think you're able to move forward pretty well. Again, the idea is that you're saving effort throughout the throughout the life cycle of settling an environmental liability by rolling costs forward rather than performing a re-estimation step or process every year or 2 or 3 to keep numbers current, to keep a fair value measurement updated. Some exceptions where there's just a lot of national data and you've got to find a local set of data to work with will be things like diesel fuel, soil backfill, sanitary sewer discharge fees. Those are where you can have a national average cost for something as mundane as diesel fuel or electricity, but you're best off finding the local price for the county that your site is in and using that as your baseline rather than a national average. There are some unobservable prices that are called for that need to be called out in identifying the fair value measurement. And examples of liabilities where we don't have good fair value measurement data or observable market prices to base an environmental liability forecast are things like claims and NERDA claims, asbestos claims. They're just problematic because, again, the circumstances of each one are just unique and don't lend themselves to averaging across a large liability portfolio. So what does that mean? If your organization is used to using terminology like probable and reasonably estimable for saying something is or isn't a liability, which is entirely normal and entirely applicable today, you may come up with a number like $2.5 million for looking at an individual site. And those costs can be broken down into study. Let's say in this example here, the study work is done. Remediation, where we got a forecast of $2.5 million for performing that field work. Remedy failure, project management, counterparty risk, the other reopeners, for example, for some sites like we've seen across our portfolios. And then the total reserve will be X dollars. And then there can be an increment from the current baseline number, the current probable and reasonably estimable number, up to the fair value measurement number. Now, let's say, for example, that is to the upper end of the range, and that could be an incremental $4 million. And that covers our example in the center of the slide here. Now let's move over to the far right and show another way that we look at the very same site, but just measure the liabilities differently. The remediation cost will still be that initial $2.5 million, but we look at increments for the components, like remedy failure would be X probability of redoing some work and then the cost of doing that work. So again, it wouldn't be 100% times X dollars, it would be most likely 50% or less probability times X dollars, which would again give us this weighted average for remedy failure. And we follow the same steps for project management, where there's a 100% chance we'll have project management and oversight costs, and we want to account for that properly. And there is again a highly variable number for what the counterparty risk can be based on business conditions, whether or not we're in a recession, and the health of the health and size of our counterparties. That can vary quite dramatically in ways that project management costs never will. So the range for each of these can vary quite a bit or not at all, and that can feed our total reserve, which would again be different from using probable and reasonably estimable alone, which might give us a minimum number, would again be sort of toward the middle of a range of where there might be a low, mid, high. The specific accounting language, likely, reasonably possible, and remote for low, mid, and high cost environmental liabilities. That language is still out there in generally accepted accounting principles, still applicable when we look at environmental reserve reporting. But if your head is sort of spinning a little bit from the different terminology that I'm using, keep in mind, again, environmental liabilities are multidisciplinary obligations and require multidisciplinary vocabulary. So again, keep in mind that if your organization is using one type of language in your organization for environmental liabilities and another type of language for all the other liabilities that it has, I think the language for the environmental liabilities is going to play catch up sooner or later. And I encourage you in doing your reporting that you include a little bit of a vocabulary update if you're doing any reporting that involves new terms as you move year to year and quarter to quarter. One of the other bits of terminology that I encourage you to take note of and use regularly when you're reporting whether a liability is more probable, more reasonably estimable as you go forward, are these working lists of obligating events and recognition benchmarks. Now, these terms are actually expressed in generally accepted accounting principles. We've just, in developing ASTM 3127, we added to them to make them more recognizable to those that are involved in good commercial and customary practice today in estimating or documenting or both for environmental liabilities. So there's a 9-item punch list to identify whether a risk is more or less probable of becoming an environmental liability that needs to be booked today. And on the right-hand side of the slide, recognition benchmarks. Is a risk more or less reasonably estimable than it was before? And 12 items are listed there. So again, I encourage you to think about those in looking at just a standardized way of communicating that a liability or a risk rather last year wasn't bookable, but today it is. It is recognizable or bookable today. And the reasoning for that can be in the last few months or the last year, a specific risk has passed one or more new obligating events and one or more new recognition benchmarks, and therefore that can be a standardized way of identifying within a liability portfolio that there's a standard set of recognition and measurement steps being taken. If you want to talk about this in more detail, again, that's what I like to do, and would be happy to talk you through this in more detail. What does that mean in terms of compilation of data? We have something that I call an environmental liability watch list bullseye, where you're looking at not just your budget, which is the very center of the bullseye here in yellow, the short-term budgets, but also what's booked in the red circle. That's the book value of your liability. And then the two outer circles here, which are the watch lists for pre-settlement, where your pre-recognition rather, where you're identifying what will have to go on to a reserve someday, prospectively. And then post-settlement, after work is done, what sort of residual reopener liability for emerging contaminants or remedy failure or reopeners due to third-party property claims, for example. What sort of things can be coming in even though construction work, remediation work is physically complete? That's, again, the outer circle. Those four together constitute the fair value measurement of environmental liabilities in a due diligence situation. Even though you may only have reserved the yellow circle and the red circle, you certainly would find value in tracking the blue circle for pre-recognition items and the black circle for post-settlement watch list items. So how does a watch list look and work? A pre-recognition watch list layout is expressed in ASTM 3123, as cited at the bottom of the slide here. And it's very basically just this 7-column display that you can build up in Excel and work accordingly. Moving left to right, column 1 is the subtype of the 5 types of liabilities that we covered very early on in our presentation here today. So again, things like whether a line item is ARO related, remediation related, commitment, contingency, or guarantee related would just be expressed in the first column. The second column over is a little more difficult to do. It's providing a sort of a site-specific definition of what environmental risk is out there today. And that involves often just saying it's related to this asset or this notice of violation or this permit that's been issued or this contractual issue that we have to observe over time. However that site-specific definition is expressed, it needs to be clear enough that it can be differentiated on the very same site from something else. So a geographic boundary is often useful, as is a recognition of the types of contaminants you might be chasing after at an individual location for a larger property. Columns 3 and 4 refer to the previous slide where we looked at, previous couple of slides where we looked at past obligating events and recognition benchmarks, and in column 4, future obligating events and recognition benchmarks. The idea here in column 3 and column 4 is you're saying, what we definitely know so far and what we think might be coming up in the near future or in the distant future for the very same issue at the very same property. Columns 5, 6, and 7 provide numerical data for that fair value measurement calculation or for adjusting a reserve in due time. Column 5 provides a probability, which can often be 100%, even though a recognition benchmark hasn't been reached or an obligating event hasn't been reached. You may be quite sure that you're going to have a 31st year of OM&M costs, that you're going to have to go from a study phase to a remediation phase on an individual liability. You may be 100% certain that it's going to happen, but not have that liability, portion of a liability booked yet. That's totally normal. That's the value, again, of having a watch list, is to say the reserve or the provision has X dollars booked already, but the upcoming portions of the liability that haven't been reservable or provisionable yet so far are just expressed here on the watch list. Column 6 is the span of dates, the range of dates when a liability might be triggered in the future, and the range of expected costs, normally expressed in a present value or a current value basis. All of that information helps define what the watch list is, but normally at a minimum, columns 1 to 4 are essential to just differentiate between what is and isn't in the reserve and what is and isn't in the watch list. Columns 5, 6, and 7 may be privileged, may be confidential, may be quite volatile or unestimable for a variety of reasons, but I just want to again express what a good complete watch list will normally look like. What are the best practices and lessons learned from looking at a watch list? Put the entries into those first 4 columns first. Then worry about timing, costs, and the range of costs and the range of dates. That part is, again, great to have, but it isn't ordinarily necessary or desirable or even practical to have every line item filled out to the level of detail that I just expressed. What you do want to daylight are columns 3 and 4. Daylight your past and present and to some extent your future recognition benchmarks and your obligating events. So for example, if you have 5-year review cycles with your regulator, you've got an upcoming recognition benchmark and an upcoming obligating event every 5 years at the latest for each and every one of your sites, where whether or not it's been expressed before, you can certainly program those in for those sites that are on 5-year review cycles with your regulator, that you're going to be revisiting what the finish line looks like for each and every one of those. Having a standardized place to express those normally is an off the reserve statement in a document like the watch list, like a table like the watch list. If you have new purchase and sales agreements, new merger and acquisition activity, or spinoffs, again, documenting the expectations of what that new event means in terms of unbooked but potentially notable and reservable environmental liabilities is what, again, a watch list is for. You have leases, counterparties that seem to be getting healthier or less healthy. If you're experiencing some remedy or strategy failure, if you own multi-party sediments, if you operate a dam, for example, and you're collecting region-wide sediments on your facility because you have some sort of surface water and therefore some sort of sediment impoundment, keep in mind that the fact that you don't have a notice of violation is normal. but that doesn't mean that the liability in a due diligence situation would be zero, and therefore that the fair value measurement of the liability, if you're ever asked for it, is zero. You can see that coming from a long way away, and therefore expressing what your settlement liabilities can be, even though, again, they're not triggered, they're not obligations yet today. You can sort of see them coming. Again, a watch list is the proper place for saying, we see this coming, but again, we don't think it'll be 0% probability of happening or a $0 outcome. The number one issue in deploying a watch list is consulting with your financial team as well as your legal team and figuring out how you're going to keep privileged information privileged. Again, before you get started, make sure the finish line is someplace where everyone wants to be and needs to be. The purposes of a watch list are to explain what isn't in the reserve. So again, it's not meant to double the duty of explaining what's in the reserve. And you're also explaining why an item is not in the reserve or provision today. And you're also making your current thinking process visible. And some of you may be surprised to hear this, but you might not be managing these environmental liabilities in another 30 years. And in the handoff, you'll find that a watch list is an incredibly useful tool for saying, these are the things that haven't quite expressed themselves in reservable activities that we need to work down or budget for or care about discharging promptly. Therefore, since they're on a slow boil or maybe no boil at all, here are some things that we know about versus we think about versus we know about. Here are some ranges of costs and timing, and then if there are some biases, cognitive biases, like we don't look at liabilities in operating plants or related to RCRA permits, for example, those sorts of biases can pop out of anyone reviewing a watch list over time. And finally, again, the major value of a watch list is to improve your long-term implementation of capital stewardship goals. That is, you're trying to keep knowledge and not pay for it again and again and again. You're trying to measure and manage similar risks in similar ways, and most of all, of course, prevent surprises, whether they're from getting tested in the course of due diligence or audits. You're trying to set expectations about what future reserves are going to be and where those liabilities will be coming from and what, if anything, can be done about that. And then set expectations about budgets and headcounts and workflow. And most of all, you're there to prevent the chronic liability buildup because liabilities were misevaluated at the start when they were just risks before they became booked liabilities. So some of the performance metrics that you can use in looking at a watch list. Ideally, 99% of reserve increases are going to come off the watch list because everyone is aware of what's coming and why, and is okay with graduating a risk off of a watch list and making it a reservable liability in whole or in part over time. 90% of the watch list items should be over 36 months old, which means they've been sitting there for quite some time and are expected to just be there indefinitely until a future recognition benchmark or obligating event occurs. Another useful performance metric can be setting aside 5 to 10% of your spending with the justification that it reduces the probability, the timing, or the cost of a watch list item. Again, that's I know it's sort of circular logic when I'm saying that reservable spending is based on what's already booked, and a watch list set of items are not booked today. But if you have, again, an increment of spending to say, so much of our spending is on reserves and so much of our spending is just in general to reduce our liabilities, you can reasonably say an increment of testing of the waters, if you will, to reduce the watch list can have a greater impact than the dollar-for-dollar spending that you might have, for example, on an O&M activity where there are many fewer degrees of freedom and fewer outcomes. Another useful performance metric, it can be making 0 trips to the archives like Iron Mountain or the file room to explain and justify what a watch list item is and that you have 0 knowledge loss over time. Other useful purposes of a watch list can be for purchase accounting valuations. You'd like to see, I think anyone would like to see, that those valuations are stable for the first 3 to 5 years after an acquisition closes. Excuse me. And then if you do want to sort the data, if it's listed in a table or an Excel file, you're able to sort by probability and confirm that you have a good cutoff for graduating a risk into becoming a booked liability, which means the step of recognition can be driven by probability. So you may say any item on the watch list that's 95% or higher should be booked now unless there's a really compelling reason, like we haven't signed the PRP agreement or we haven't been issued the final remedial design instructions by the regulator for a cleanup project. You may have great reasons, but ordinarily you'd like to see that probability cutoff that you have be responsive to your decisions to include or exclude individual risks from a liability calculation. And finally, no items with any probability under 3% should occur in the first 5 years of implementation. That's just good reassessment of how accurate and responsive the calculations were to market conditions. After the work is done, after field construction work is executed, you may find value in keeping tabs on environmental liabilities that are settled or closed or zeroed out, if you will, by keeping a watch list, again, of risks that are not booked as liabilities today. You may find it useful to have a sort of a reopener list for things like emerging contaminants, for natural resource damage claims, or just the remedy failing, or neighboring property owners identifying a contaminant transport issue onto their property. Those, again, are expressed through column 5 with the probability, which you may not populate. You might not find value in populating that, or column 6 and 7. But again, the idea of a post-settlement watch list is even though you've said goodbye to spending money on a liability, you do identify that there's some residual risk that's still there, and that this liability may cause, that this risk may cause the original liability to reopen and need an incremental reserve in the future. One part of looking at different projects of different sizes are that they need different levels of care when it comes to capital stewardship activities like event trees and Monte Carlo modeling, looking at different remedial and non-remedy scenarios and so on. So I pulled out this table from ASTM 2137, which is the ASTM standard guide for estimating environmental liabilities. And I pulled up this table to give you a sense of when you might need to take more steps in looking at a liability. If the current estimate of the cost to close is under $500,000, for example, you may only do half of the steps that are listed on this table. If you're looking at a $5 million plus cost to close, you'll probably be doing every one of these steps, and some of them you'll be doing keeping updated on an annual basis or close to it. So again, keep in mind that if you do have environmental liabilities, a $100,000 line item for an individual project to carry out a remediation or O&M activity, a $100,000 line item is on the small side, on the very small side, which also means there's probably quite a few of them, and you may find some value in carrying out a detailed estimate and cost bracketing, just as you would for financial assurance, and reporting to a regulator what your cost forecast is. But as a liability gets more expensive, and more expensive means $100,000 to $1 million, that's sort of the middle of the pack these days. Some organizations may say up to $2 million is the middle of the pack, and then over $1 to $2 million constitutes a larger site that needs more resources and a longer time to implement, and maybe has more moving pieces to it. The takeaway that I just again want to give to you is that higher expected cost sites, remediation liabilities, mean more cost engineering, which are the steps that I've got listed on the left-hand side of the slide. I'll cover some of these in a little more detail to give you a sense of what they look like these days. An event tree is what we used to call a decision tree, and gives a framework for not just decisions, but also the random uncertainties that are out there, as well as the negotiated outcomes that are extremely common for looking at environmental liabilities. The symbology that I use with the diamonds and the squares and the circles actually do follow what's available in software tools like Precision Tree for Excel, and also what's just standard common industry practice, again, for breaking out decisions from uncertainties from negotiations, which is an important part of writing a good decision tree. You don't want to merge all of your decisions with all of your uncertainties and just convey them as all slightly different outcomes that you can and can't control. You want to have some rationality to it, and this rationality is expressed in a sequence with these different silos moving left to right. And again, this is the recommended order from ASTM 2137, which is the environmental liability estimation standard guide that's out there. Where you may have additional components that you add in over time, or where you have decisions about your treatment disposal technology, and then you decide based on choosing one of those different treatment technologies that you have some incremental counterparty risk of default to think about. And that's expressed in the graphic that you see in the top half of the slide here today. The takeaways that I wanted to share with you is that professional judgment is essential when it comes to selecting which uncertainties, negotiations, and decisions to display. You can display dozens and dozens of decisions, from the mundane to the tedious and innocuous, but where you have, again, the opportunity for using good professional expertise is in breaking something down into digestible, manageable, memorable components. And again, keeping the discipline of the uncertainties are separate from the negotiations, which are separate from the decisions, moving left to right. And again, not miscommunicating any of the probabilities and missing out on the documentation of your thinking is, again, two of the principal values of having an event tree in the first place. But to get those, you really do need experience, professional judgment, and while we've all got the ability to Google things and buy the tools like Precision Tree, the expertise that comes from having a reliable, validated, audited event tree that stands the test of time is something I think that every one of us would earn rather than expect to have very, very quickly. Again, keep in mind that, again, developing expertise in communicating environmental liabilities through event trees, mandatory for being able to effectively do an expected value calculation and for doing, therefore, a fair value measurement calculation. But I think it's also good for, again, documenting your thinking to others that are not close to individual environmental liabilities, but like to see rigorous thinking and see rigorous professional judgment applied to looking at an individual liability, even though for you looking at a portfolio of environmental liabilities, after you look at 5 of these, they can all start to look the same. That can be, again, part of the gift of doing of looking at similar risks in similar ways, is that the event trees all start to look the same in time. I hope you get there quickly if you're not there already. If you need help getting there, here's my 4-second infomercial. Call me. I love this work and would be happy to help you. The final takeaway that I want to share with you is, again, keep your decisions separate from your uncertainties and keep the decisions you make from others, your negotiations, separate from those other two. Very important discipline to keep going forward over time. If you do have a higher cost site, again, over the $1 or $2 million mark, you'll probably find value in completing a step called Monte Carlo modeling or financial modeling, where you use Excel to its more extreme capabilities in random number generation and scenario or case analysis to identify the range of cost outcomes rather than generating a single outcome for an expected value. You can in turn have a continuous range of outcomes expressed through probabilities. So the way this works is generally by having a standardized work breakdown structure. So again, similar sites are evaluated in similar ways, and that individual line items are bracketed back to, as we saw in practice number 1, a single assumption spreadsheet in Excel. You'll find yourself very happy to have all of your assumptions that you're bracketing all expressed on a single page. It's just a good practice to make sure that, again, you're not missing things or you're spending too much time bracketing small dollar items and missing the point on larger cost or higher uncertainty items. The third practice, which is I think where the art in financial modeling exists, is in picking the proper distribution. And here in this example, I've got 7 distribution types listed, even though there may be 20 or 30 available in a given Monte Carlo modeling tool that works in Excel. I found that through trial and error over the last period of time of doing this type of work, that these 7 distributions are the most common that you use. The rest are built for other purposes or just in general tougher to apply to environmental liabilities. So in this table here on the right-hand side of the slide, I've identified when to use these individual distributions. and then provide an example related to that. So let me give as an example a triangular distribution, and it's applicable for where we've got a higher confidence estimate for our minimum, most likely cost, and our maximum cost. So say, for example, we expect to have a remedial study. Our likeliest cost is $100,000 plus or minus 50%, which means the minimum number is $50K, the maximum number is $150K, and we have a triangular distribution constructed around those three data points. Fairly common, very simple entry-level use. It's very simple to audit, very simple to test for reliability over time, and again, it's a good entry-level point to start with. A more complex distribution toward the bottom of the list is the Weibull distribution, where we've got a strong expectation, if not an absolute belief, but a strong expectation around what a 10th percentile or an optimistic cost outcome looks like, a P50 or a median value a cost outcome is going to look like, and a P90 or a pessimistic cost outcome. This isn't the absolute minimum or the absolute maximum, which would be the P0 and the P100, but instead are just walked in a little bit toward the center of the distribution function. And what happens with constructing a Weibull distribution is the Monte Carlo modeling software, whether it's at-risk, SIMMath, or Crystal Ball. Those are the three most common tools out there in 2019. Those tools give you a sense of, again, the interpolation and extrapolation of values that are the P15 or the P55 or the P99. Those values pop out because the software uses, again, the arc of those three data points to construct every other value from the 0 to 100% range of outcomes. So with that in mind, the fourth step to get right is to focus through on your process to make sure you're working through a reasonable range of alternatives, which means your decision tree or event tree has been thought through adequately, tested, peer-reviewed, double-checked with experts, and so on. That you've also, again, systematically worked through the entire work breakdown structure and built up, ideally, a cost-loaded schedule that reflects the reality of how fast or how slow you'll need to implement a project. The important part of the previous slide of adding ranges for achievable outcomes are making sure the ranges are wide enough that you think about the different reasons how costs can expand beyond an initial conceptualization. Keep in mind, consultants don't like to be the messenger of bad news. They don't like to be the ones to say, you know, yeah, we're bidding $100,000 for this environmental assessment, but it could triple if we find X in the ground or we find contaminants Y or Z in the groundwater. The cost could triple. The messenger hopes you know that already, but again, keep in mind that if you're doing the financial modeling, you may hear one set of numbers from the vendor community, and your experience may tell you two or three other things on top of that. Keep in mind that eventually, when you have more than one variable put into a Monte Carlo model, you'll have to go through a process called statistical correlation in order to not have unreliable numbers on the back end as a result. So statistical correlation means you're connecting the probability that A and B and C will move up and down together, or A and B and C will cancel each other out or behave randomly. The default is that they'll behave randomly, like three different stocks in three different stock markets around the world. But the reality is, for environmental liabilities, if you're spending more in one area, you're probably spending more in another area as well. And there's an invisible hand that's moving the liabilities up or down within a range in concert. Again, that's a positive statistical correlation that you can't expect. And again, if you'd like more detail about it, feel free to look at one of our other webinars about environmental cost modeling on our YouTube page, or give me a call and I'll be glad to walk you through it sometime. What you get on the back end in terms of results from financial forecast modeling is you get a probabilistic forecast that gives you a range of outcomes from 0 to 100. As you see in the table in the lower right corner, you get a P0, P10, P20 number, and so on, so that, again, all of the values that you might need or want from a range of outcomes are expressed accordingly. What that does mean in turn is that you've got an arithmetic mean or an expected value of, in this example, 3.154 million that pops out of your modeling process. And that number may inform what you reserve, and it may inform what you put on the watch list. And the 4.275 number you see as P90 may be, again, a number that you express as a risk of an extreme negative outcome for an individual liability or project to settle a liability. Where you may have a need for comparison, where you're looking at scenario 1 versus 2 versus 3, this sort of display of a cumulative probability distribution, this gives you a very easy basis for saying, scenario 2, it looks like it's most competitive over every percentile of probability. Scenario 3 looks like it's uncompetitive with scenario 1 or 2 at every probability as we go from the lower left to upper right. So again, 3 is a scenario that you can, if you have the power to, like a technology selection, say, that's not something we're going to go for. And because of the slope of 1 versus 2, we prefer, if we can, to go for scenario 2 versus scenario 1. That's, again, 2 of the things that can come out of using a probabilistic forecast comparison is you can figure out what scenarios are not going to be workable and whether in a 1 versus 1 comparison, if one is more attractive to your organization, all other factors being equal. Once you, again, have that information together, as I noted in the previous 2 slides, you're able to inform what your watch list and reserve can look like, and that in turn will lead you to equip you in turn for looking at your reserve review meetings. So with that in mind, I want to give you a sense of how to use this information from best practices and lessons learned in the first 2/3 of our talk here today for reserve review meetings. And that'll be the remainder of our presentation here today. So when you conduct a reserve review meeting, I think you might find value in following this sort of agenda. It's, again, come up through trial and error, and I hope you find it useful. Number 1 topic can be starting off with a slow and easy basis of comparison to say, here's where we've come in the last 10 to 30 years. So perhaps graphing out a 20-year time horizon, and if, to the extent the data is available on your peer organizations, show where they've been coming from too. Has everyone been accumulating environmental liabilities? Has everyone been working them down? Have there been sudden recognition steps for environmental liabilities? Great, here's where you can give a sense of how your organization is comparing to your peer organizations elsewhere in your industry. The second agenda item I really recommend is covering closing projects. How did these liabilities get extinguished, settled, derecognized? How did that successful outcome happen? The next agenda item I recommend is looking at new liabilities or risks that are graduating from the watch list onto the reserve due to having new obligating events and or new recognition benchmarks. The fourth agenda item I recommend is the watch list covering increases in particular that are occurring now or in 2020 or later, and then any proposed reserve increases for 2019 and any proposed reserve reductions for 2019, including those that are possibly going to revert back to the watch list for safekeeping for a while. The stakeholder expectations that I commonly see in environmental liability reserve meetings are an interest in seeing predictable reserve increases, spending that matches liability reduction rather than spending simply going for spending's sake, that similar liabilities are getting handled in similar ways, and that if there are trends, that there's some rough idea, like 1,4-dioxane, PFOA, PFAS, that there's some idea of a rough order of magnitude cost, meaning is 1,4-dioxane going to be a $1 million, $10 million, $100 million issue, looking across over the next generation, across the entire portfolio, just what sort of rough cost we're looking at for handling those incremental new liabilities. Again, keep in mind a reserve review meeting or a liability review meeting is not some other things. It's not a budget meeting. It's not an audit meeting. It's not an audit. And it's not a decision analysis meeting on individual sites. So if you do see a liability reserve meeting trending into those topic areas, stop and recycle for a minute. Here I just want to give you 2 examples of what an industry comparison can look like. And for this, I pulled out a comparison of the 4 integrated oil and gas E&P super majors. They like to compare themselves to each other quite a bit because they're just all in that same financial weight class with global operations and asset bases over $200 billion. And again, what can pop out of these things are things like, for asset retirement obligations, everybody's AROs grew from 2003 to 2015 and 16. Everybody's liabilities just grew. It just happened. But then something started to happen in 2012 that really was really in effect for everybody in 2017, that the liabilities leveled off for the first time in the industry. Part of it was a little bit less investment, but most of it was everyone's capacity to settle the liabilities grew quite a bit. In other words, the capacity to do the settlement work grew quite a bit from 2003 to 2017. And I think in 2017, the capacity to do the work and start to work down the liability balance, or at least level it off, was finally reached in 2017. 2018 numbers will be out in the coming weeks, so I'll be delivering this as part of an updated presentation in the near future. For the remediation liabilities, the numbers are quite a bit smaller than the AROs on the previous slide, and you see the volatility moving around quite a bit. For Exxon, you can see the impact of the Exxon Valdez spill in the 1989 and later years. You can see the financial impact dropping due to an accounting policy change in 2003, and Exxon's liabilities have been the lowest in their peer group in that time span. You'll see Shell and Chevron sort of moving in a comparable band of roughly $1 billion to $1.5 billion over the last 10 years. And you'll see BP going through the impacts of acquiring or merging in the operations of ARCO and Amoco in the late 90s, and then going through the unfortunate experience with the Deepwater Horizon spill in the Gulf of Mexico in early 2010. Which again, for the most part, seems to be behind BP, the green line you see at the top. And so again, all the environmental liabilities seem to be for the four super majors in this relatively narrow group of about $800 million to $1.5 billion across their international portfolios worldwide. So again, a couple of points about conducting a reserve review meeting. It's important to have good performance indicators, which are often a mix of leading indicators, current, and lagging indicators. Some of the leading indicators that you may want to talk about where this program will be in the next few years are where the watch list is today and where it's moving. What's your cutoff for probability? Is it 51%? Is it 99%? If it's one of those two numbers, you have some interesting discussion points to cover because there's some divergence from common practice where the definition of a cutoff for probability can be in the 65 to 75% probability range. If you need some citations about that, go to ASTM E3123 for the accounting background on that. We did some detailed research on that standard guide. But again, keep in mind that if you're doing 99% probability or higher for an item graduating off the watch list into the reserve, that's a tough test. And a 51% probability is a really easy test. And that, again, varies quite a bit from what your peer organizations, on average, seem to be doing today. Other leading indicators can be new sites coming into the portfolio and a reclassification of reserve projects into CapEx, or capital expenditure dollars, operating expense dollars, asset retirement obligations, or brownfield projects. Your current real-time indicators of how your environmental liabilities are performing are your dollars per ton or dollars per cubic yard for handling soil, your dollars per gallon, or hopefully cents per gallon for processing water, treating and discharging it, and finally dollars per pound for extracting the original contaminants. Those again are good performance metrics. If you don't do them now and need some ideas for how to do that, let me know. I'll be glad to sketch those out in a few minutes for you and give you something to work on for your portfolio. The burn rate of current reserves, everybody sees this. It's not really that instructive because the burn rate, the spending rate is just that. It doesn't always perfectly correlate to how fast the liabilities are being settled and worked down. Some liabilities don't go away until all the work is finished. Some liabilities start to go away as source material is removed dollar for dollar with spending. So again, it's not a perfect measurement for how liability settlement performance is happening. Some of the lagging indicators that you may want to report are the old sites that are leaving the portfolio, for example, where work has been completed, discharged, the regulator signed off on, or the liability was transferred, or sites that are in turnaround or in some sort of technical difficulty for achieving a financially viable outcome for removing the source and treating soil and groundwater.
The general reserve goal should always be a useful philosophical point to end on. Are we trying to manage our accumulating reserves and projects? Are we trying to maintain our reserves at a given level or within a given range? Or are we trying to work that down over, and here's where pace to closure comes in, over 5 years or 10 years or 30 years? These will be a good expression of your corporation's values and budget priorities and financial health and so on. But if you again have some general direction, general discussion periodically about, we accumulate liabilities of this type, we maintain or work down liabilities of this other type. These are very useful philosophical discussions to have just to sum up and wrap up where the liability portfolio is going. Again, keep in mind when you're conducting an environmental liability reserve review meeting, no vendors, no facilitators, no rookies. You're trying to preserve privilege, and you're trying to only involve people that are the most committed to the long-term outcomes. And that, again, is a subset of who's normally working on environmental liabilities. Some of the out-of-scope questions that pop up in looking at environmental liabilities are getting into site-specific details or performing a decision analysis. And again, it's a topic for a separate meeting at a separate time. But if you're looking at a full portfolio and you start to deep dive on an individual site's decisions, it's time to, again, move the agenda forward. So if you come up with questions, you hear questions like, will a given solution like this remedy fully settle the liability? What's the backup plan? You've gone into site-specific decision analysis topics, and again, that's not part of a full liability reserve review meeting. Did we initially set a value on a site's liability, and if so, how are we doing against that? Are these prices accurate? Are the labor rates that we're getting charged subject to change orders? Again, those are the minutiae of individual sites and a good topic for a later time. But unless you're getting through your one major large site, and that's the only site where you're going to get into these site-specific decisions, it's time to, again, fold those into a separate meeting. Other out-of-scope topics are things like procurement. Are the vendors that we have in place today charging market rates, or are we getting a better deal than average or a slightly worse deal than average? And how do we know that? Again, procurement is a separate issue, as is real estate. What are we doing with similar properties? How do we want to position these properties for beneficial reuse by others over the long term? And then finally, legislative and regulatory affairs. For example, what are we doing about inefficient remediation systems that are in turnaround or facing technical impracticability? What are we doing with those sites? That again is a site-specific deep dive or a topic for a legislative or regulatory affairs expert, and not simply focused on how the liabilities appear and what options are available for managing them over the longer term. So again, if you're getting into legislative, regulatory affairs, or real estate or procurement, and you don't have representatives of them in the room, it's problematic to carry out a discussion without them there. As a final closeout topic to having a reserve review meeting, I find it's very useful, very important to document decisions that are made right then and right there. So if you're agreeing to update a reserve, document the original basis that it was yesterday going into the meeting, document what increments were agreed upon, even if those are rough order magnitude numbers or rounded numbers, as you see here on the slide. Document that change so that you can forget about that until the reserve review meeting comes up next year or the year after for that site. Let the aggregation of those reserve changes feed into needs you've got about the need for contractors or for staffing changes, and in turn use that information to highlight any accomplishments that you want to underscore, but particularly if you want to repurpose your lifecycle cost forecasts for your M&A team or your disclosure team to use in repurposing your forecasts, for using your watch list to express how pessimistically the environmental liabilities might turn out, and then if you're doing benchmarking, how you might bring in your costs below an industry standard reserve for a similar site, and how you're keeping touch with your data and your industry and institutional knowledge. So just as we round out our presentation here today, I just want to give you a couple other points of content for our meeting, for your reserve review meetings. These are metrics that were developed by ERCI and were contributed to ASTM for use in the ASTM Standard Guide 2137, which is for disclosure of environmental liabilities. So the copyright holder for the next 4 slides that I'm going to share with you are ASTM, but the originator is on the phone with you here today. So some of the aggregation activities that you may want to use are how to roll up a multi-site watch list. What we looked at as a watch list item before was just for an individual site, and you see here that in aggregating the data from the three rightmost columns about timing and about the range of costs and about the probability, that data from columns 5, 6, and 7 is aggregated here for the full portfolio. So again, that's an example of rolling that information up so that you've got a range of outcomes for your future reserve increases. Other content that you may find useful to report are just site counts for your asset retirement, your remediation, your asbestos and NERDA claims, your commitments and guarantees as you're reporting financial assurance. You may want to just identify if there's lots of turnover or if you're watching the same X number of sites year after year after year. 3 years is sort of the standard level of display of the current year in progress versus the 2 priors. That's the normal standard of care, so I followed that example here throughout our displays. In the bottom half of the slide is just a tracking table showing how the liabilities were starting with an initial value on January 1, and then went through some processes where liabilities were incurred or added on, settled, usually via spending, where there's an unwinding of the discount rate called accretion, and then finally some revisions to estimated cash flows from reestimates, which can send a reserve number up or down, and then that end of the year number in 2017, for example, becomes the year start number in 2018, the next column over. This sort of progression, which the eye naturally follows over time, does help give a sense when someone looks horizontally in the rows of whether we're incurring lots of new liabilities, whether our spending is quite volatile, or whether our estimates are being revised quite significantly. This gives a level of detail that the top line number just doesn't give, of just saying our reserve is this. Having these components is actually expressed in FASB and in general accepted accounting principles. This is formally called a tabular summary. And if you look in 10K reports, you can probably find a display using these items A, B, C, D, E, F listed in that very order perhaps in your organization's 10K report today. Another useful display for internal consumption can be the portfolio assumption tracking, where you're looking at changes, or perhaps more importantly, the consistency, and looking at things like your inflation and discount rates, the time horizon that you use to look at for long-term liabilities, and whether you're looking at expected value or low end of the range as your common basis for estimating a reserve. Again, those are highlighted in yellow, and I just want to again say that this is a basis for communicating whether there are significant changes over time. So perhaps even a 5-year display of these metrics, if you start accruing for them, accounting for them today, you'll be ready in 2022. Can give a good basis for saying, our changes in estimation methods were part of the reason our liabilities went up and went down in the fashion that it did. And then finally, the fourth slide that I want to share with you gives a sense of what's in the reserve today in row F, but then also that increment number 1 of what's reasonably possible, and then increment number 2, that remote increment. So again, if your organization uses terms like likely, that'd be row F, reasonably possible, that'd be row G, and then remote, that'd be row H. That can then give a sensitivity analysis of, aside from what's on the watch list, what financially that means in terms of future reserve increases over and above what's in row F. That can again be a useful expression over time. What users like to see is row F, the reserve number is declining over time. The liabilities are going away. In row G and row H, same thing, that they're pancaking, that everything is decreasing over time on top of each other, and that the spending is achieving not just reduction in reserves, but also reductions in these reasonably possible and remote increments concurrently as well. So just to sum up, and again, just to confirm we're caught up on questions, the essential topics in your liability reviews are making relevant reports with predictive data about the future, confirmatory data about the past, providing data that's a faithful representation, which means it's complete and neutral and free from error. These are all accounting terms, but I trust that you know that these have universal meaning to all of us. And we're also, again, interested in improving capital stewardship, how we're involving our people, our money, our reputation and attention, and showing that even though we may not be perfect today, we're certainly improving from where we've come from in recent years. How do you combine professional and enterprise success? One of the ways you can be doing that is by making your thinking process visible. I find that event tree modeling and watch lists are incredibly useful parts of the process that feed up to good discipline in reporting environmental liabilities. That in turn leads to a good, solid audit defense that's rational and systematic, and then future decisions that are framed and open for input and not presented as just single outcome issues where there's no opportunity for leverage or improvement available today. So with that in mind, I just wanted to close up on a couple of points. I'll be sending over a follow-up survey just to ask about your feedback on today's presentation. If you have any information needs that you have on ASTM standard guides, that's been my pro bono nonprofit contribution of time and attention over the last 4 years. Feel free to ask me any question if you'd like. And if you need more detail about ERCI's webinars, you can keep in mind there are 27 of them posted on our YouTube page. So thanks for joining us for this webinar today. Let me stop the recording